And I'm back with another back test. This time it's going to be ICT's first presented fair value gap. It's a back test summary for NQ and ES, and the data period is about 2 years from March 3rd, 2024 to March 2nd of 2026. So if you're new here, what I do is I take trading strategies and I convert them into Python code and I backtest it against historical data so we get results a lot faster than what it takes to manually look at charts. The reason why I started doing this is because I was just tired of going in circles. I'm just like everybody else looking for an edge in these markets. And every time, I'd spend hours and hours backtesting and it would look good in the backtest, but when it came down to it, every day is just different. And so I really wanted to dial in my strategy, and that's when I had the idea of putting it into code and really backtesting it on a large period of time. And that has significantly changed the way that I look at the markets. So for this backtest, it is ICT's famous first presented fair value gap. And before we get into it, let's go through this trading disclaimer that, this material is for educational, informational purposes only. It is not investment advice, trading advice, a solicitation, or a recommendation to buy or sell any futures, contract, security, or financial instrument. Backtested results are hypothetical and do not guarantee future performance. Markets change, slippage, commissions, data quality, fills, latency, and execution rules can materially change live outcomes. Any trading decision, risk sizing, or live execution is the responsibility of the trader. Use this report as research direction only, and then forward test and validate independently. So here is a detailed logic. We'll look at this and then I'll show you on the charts before we get into the data. So for each trading day, I read the full 1-minute session data for NQ and ES. We're looking for the first presented fair value gap, and candle 1 must be after 9:30. So 9:31 or later for New York time, the New York Open. Fair value gap, the code finds the first 3 candle fair value gap presented after the open. Bullish means candle 3's low is above candle 1's high, and bearish means candle 3's high is below candle 1's low. An entry is a trade counted only if price later comes back in and touches the fair value gap zone. Stop loss is risk defined from the entry area to the invalidation side of the fair value gap structure, which I'll show you here in a minute. And then we measure how far the price moves in R multiples, so 1R to 3R and even higher. And the cool thing about computer code is you can add extra context. So extra context is recorded such as the weekday. So certain days of the week, if we gapped up or gapped down before, the 4-hour opening candle, like is it bullish, is it bearish? So a lot of that stuff may not be in this report, but it'll be on the full CSV file that I'll put on my website, pythonbacktesting.com, when I launch it. Okay. So before we get in the data, let's look at the chart. And I have a couple examples right here just to show you how this code is written. So the first one is going to be from February 24th, 2026. It's a Tuesday. And this one results in a 3R. So this is it right here. So February 24th, we have for me, it's 7:30, but for New York time, it's our 9:30 open. Okay. And so we do not count this as part of the fair value gap since it's the 9:30 candle. So this one, fair value gap right here, does not count. Instead, we wait for the next presented fair value gap, which is going to be here. And the invalidation is going to be the low. Let's make this red. And the entry is going to be as soon as we tap into that fair value gap. So for this trade, it shows our entry at 68.4925 and our stop loss is at 68.3025. which matches the red line right here, the bottom of the fair value gap, 68.3025, and our entry at 68.4925. And so we wait until price retraces back into this gap or the entry, which was right here, and then we measure. So this should hit a 3R before it invalidates. Doesn't look like it hit right away, but it hits. Boom. Right there. So this one was not quick, but it did result in a 3R, and that is what the code is written for. And here's the results. So this is for NQ and ES. So 92% of the time we touch back into that fair value gap. And if you just played every fair value gap from the last 2 years on NQ, you'd have a 58.1% probability of a 1R, and ES just about the same. And then you got your 2R column and 3R column here. Here's a summary by weekday. So Monday, 54% probability on a 1R. And it looks like the best days to play this for NQ is going to be Tuesday and Thursday for your 1R. Best day to play this for ES is going to be Wednesday and Thursday. And then this is an additional filter. So basically, if we gap up pre-market, then you have a 1R probability of 62% based on the last 2 years for NQ, and 56% for ES. And that's all I got for you on this one. ICT's first presented fair value gap, holding up, holding strong for a 1R. Okay, so if you like this video, please like it, subscribe, leave me a comment, help me gain some traction, and go to this website right here, is pythonbacktesting.com. It's something that I'm working on, and here, once it goes live, you'll be able to check out these PowerPoints for the different strategies I backtested. You'll be able to look at the CSV results with all the different filters, and best of all, you'll be able to check out the Python code that I use to run these backtests, and so you guys can play around with it if you want. Go down, make sure you put your email in right here, hit the get notified at launch, and when this page is about to go live, or when this website is about to go live, you'll get a notification. Till next time, thank you.